Hey, good evening, wonderful people. Welcome back to Avoiding Broke with me, Jermaine. And guys, for anyone who celebrates Happy Halloween, hope you're having a really awesome 30th of October. So guys, today I want to take you through some thoughts about money. And so on Avoiding Broke, money is one of the topics that we love to talk about a lot. It's the topic of our weekly podcast, and we try and do as many of these whiteboard sessions as possible, just running through ways to think about money, challenges to your money, ways in which you can actually make better financial and money decisions. And what we've seen right now, guys, some crazy stuff happening. So in the US, for example, we've not got the passing of a new stimulus bill. So that's obviously having an impact on people's money, people and businesses. In the UK, we've just had confirmation of another lockdown and non-essential businesses closing. So again, you're having impact on real people, real businesses. And so it's really pertinent that right now, we as individuals have got a better understanding of ways to think about our money and ways to manage it. So in this video, I'm just going to cover some of the key stores of value that we typically have, and just look at some of the risks and benefits that we might be seeing. And these are some things that you for yourself may want to kind of reflect on and just think about whether or not there are any good action steps in there that you can take to improve your financial position. So as ever, let's just jump straight into the whiteboard. So guys, right now, the first thing I want everybody to get super clear in their mind is that every single money decision that we look to make right now has got an element of what they call volatility attached to it. So the really simple way to think about it is if all of us live in the world right now, and let's just call this very strange diagram the world, we have got a load of different things that are happening around it. And I'm just going to put these arrows to indicate events. These events are changing the direction of where the world is going. And in turn, those events are changing what's happening around money. So the risk that you have associated with your investment, with your savings, they all look different. So this world is driven by these events, and one of the outcomes is that we have got what is called volatility. And let's just think of that as risk. And it's risk associated with all the different decisions that we may make. So any single decision you are looking at, really be mindful of the different events that could impact it. So for a lot of us, one value store is our house. Now, your home is not only somewhere you live, but it's also a potential investment vehicle. And you'll see and know from our channel that we are big investors in real estate. We love property investing. And so as a store of value, your house is a big store of your pounds or your dollars. But the risk that you need to be really mindful of right now, you've got interest rate risk, which may change the amount of money you're going to be paying back on your debt. So if you've taken a mortgage and you move to what's called a floating rate deal, like a standard variable rate, you will have some interest rate risk associated with it, not just now, but potentially in the future. You're also going to have some debt, some risk related to the equity you have in your home. So some of you may have heard the term negative equity. So basically what happens is you take a loan against a property, there's an assumption that the property is worth one amount, but if it falls in value, then you are paying off a bigger loan against a less expensive, a cheaper asset. And your equity becomes then negative, so you're effectively overpaying for what you have. This is a really important risk that we have. And even though we've not seen so much of it coming through now, you've got to be aware of it, because if the housing market takes a turn for the worst, some of you know in my earlier predictions, I kind of think Q2 next year, we could see some funny movements. If it changes, the potential for negative equity could increase. I'm going to be watching that closely, so you stay tuned and follow me and let's have a look and see what we think. The other really interesting risk we have here is if you're an investor, you could be facing repayment risk. I mean, look, let's be clear. You have this risk if you own your property. So if you're an owner-occupier, you've got to be assessing your ability to repay the debt that you have. So there's a repayment risk there. But equally, if you're an investor and you're looking to let your property, you've got repayment risk from your tenants. And guys, when I'm asking questions, I was just out on viewings today actually, and when I'm asking questions, I'm asking people how they are trying to account for the extra repayment risk that all tenants have. Because I want to know that if you're managing a property for me and you're sourcing tenants, I need to be understanding how you are managing that risk. Because the old methods don't necessarily work as well. And I'm on people with that, guys, and I'd encourage you to be the same. So your house has got a lot of natural risk attached to it. Another really interesting one we see right now, and guys, there's a lot of people who are talking to you about the stock market. And I'm just going to put stock market here as value store number 2. Stock markets have been really interesting, guys. So anyone who's been following global markets, we were seeing big sell-offs and big devaluations in the last week. Really incredible. If you've been following the podcast, you'll know that I think it's around a couple of weeks ago, I liquidated all of my portfolio. Leanne did the same. And I basically went into cash. And I'm a big believer in commodities. Because I just felt the stock market was overheated. I felt bonds were too expensive. And I just didn't like the amount of volatility. The amount of opportunity for variance. Didn't like it, didn't sit properly. As a result, I've obviously been sleeping well. But I know some people have lost money because basically if you just look at like performance in markets, ideally you see kind of relatively straight lines and you see an upward trend. Typically, you have peaks and troughs. But when you've got a lot of volatility, your upward trend doesn't so much exist in the purest sense, and the peaks and troughs become exaggerated. So what you see as these kind of smoother cycles, they can look a lot more erratic. And you can see that layering didn't quite work. But you get the point, guys. Stock markets have had huge amounts of volatility right now. And as a result, what did we see? We saw prices, values, we saw them fall. Crazy. Now, I've seen some people suggesting that this is an opportune moment to then go and start dumping all of your money into stock markets because everything is looking cheap. Guys, in my opinion, that is ludicrous. That's how you go broke. On this channel, we are about avoiding broke. So guys, what I'm going to tell you straight up right now, when you look at your stock market exposure, you've got to have a sense of whether or not you think the market is overpriced. Let's be clear. You're not going to be thinking the market is underpriced right now. That would go against everything anybody's thinking. It's not looking underpriced. But you've got to have a view on whether or not you think it's overpriced. You've also got to have a view on what you think the underlying inherent value of the actual asset really is. Underlying value. So if, for example, you are basically looking to invest in a service or you're looking to invest in just a product which is not really backed by anything, and if it is backed by something, it's something that's not in particularly high demand, it's something that is an industry that you think is not going to exist in a few years' time, what really is that underlying value? You've got to really question that. And the next thing I'm going to be looking at closely on the stock markets here is I need to be diversifying, right? Diversify. And guys, diversification is crucial because it sits across everything that we're looking at here. When you diversify, you spread your risk. So we've spoken about volatility as being a component of this market. Diversification is what helps us manage this risk. So diversifying is all about investing in a broader range of assets. And by doing that, you basically don't have all of your risk concentrated in one place. You've got it in multiple places. So if you look at what we tend to do, I feel we are quite well diversified into real estate, into commodities, into cash, and to an extent in the stock market. But I really, as I've said to you, I've really liquidated a lot of my positions. I sold up and I'm holding what I think are going to be safer assets because I don't quite like where the markets are right now. But I'm diversified. My risk is in different places. And so if one thing goes down, I've still got the chance of having good stores of value in other places. That's a key, guys. Diversifying is really key. So anyone you see giving that advice to say lump in, S&P 500, buy, I would be looking, thinking, how am I diversifying? How am I balancing my portfolio? How am I spreading my risk? How am I managing my volatility? So stock market's really important. Guys, closely linked to stock market is your pensions. So a lot of us have pensions, right? And in the States, you've got your 401ks and you've got your IRAs. Yep. And when you look at these investment vehicles, it's really, these are more savings accounts, right? But let's put on here pensions, 401ks, IRAs, and let's also put on here ISAs plus savings. The key thing with these different types of savings vehicle, guys, is that you can be invested into different underlying different assets, which can include the stock market. Less the case with just obviously a regular cash saver. But my point here is that these all represent savings vehicles. And those vehicles, you will have made financial decisions around them, which could include going into the market. So what you need to do for all your savings, guys, is you need to do as per number 2. You've got to have a look at what you're in. So I'm going to put let's put prompt up here first. What are you in? What are you invested in? You've got to consider whether or not it's overpriced. You want to be thinking about the underlying value, and you want to ensure you diversify. And I think the same principles, guys, really apply to how you're going to be managing your different savings pots. These things, guys, are real fundamentals, because what you're going to find is you'll be in different situations, different scenarios, and these different ideas, they actually account for a huge amount of the financial exposure you have. So for many people, the biggest financial commitment they have is their property. And when you've got your property, you need to be making sure you understand your interest rate risk, because that's going to go in your repayments. You've got to understand your position in terms of your equity, because you don't want to be holding more debt than your property is actually really worth. You never really want to have a sketchy debt profile, guys. You've got to be really careful about managing that. And you've always got your repayment risk. So if you're in a position where your job could be at risk, you have got that repayment risk to make sure you're managing. And this is why we have things like buffers, why we have emergency funds. This is why in some of our other videos we talk about making sure you've got 6 months expenses. Because your buffer and your 6 months expenses, for example, that's what's going to help you manage these risks, and it's going to put you in a much better position. Then what you'll find for some others is once you've actually decided, okay, I'm fine with my property, I'm fine with my housing, you still often have other types of exposure. And basically right now, cash is, whilst cash can go down in value, it can easily go down in value due to inflation, it's still relatively safer than these other assets to which you could be exposed. So basically what we'd have here, as part of diversifying, is we would basically have a pot of cash, which is basically going to be what you use to help manage your risk. Now, it doesn't mean you're going to keep cash forever. It just might mean that you've got your pot of cash right now, because that is basically safer, where you've got a predictable rate of interest, even if it's very low. It's a lot safer than being exposed to the stock market right now. So once we've decided that we've got our house in check and we understand how we're managing that risk and that debt, think about your exposure to other things outside of your control, where volatility is very high. And for investors, that's going to be the stock market. Anybody who's been investing, anyone who's got a portfolio who's checking it regularly, they may have seen some things they don't like happen recently in terms of value. Guys, these questions that we're flagging here in terms of what are you invested in, where are the prices, what is the underlying value, how diversified are you really? These are great questions that you should be asking yourself as fundamentals. And importantly, stock markets cover for me your medium term. And when you look at things like pensions, 401ks, IRAs, ISAs, savings, the pensions, 401ks and the IRAs, this is your long term. And then to an extent, you might say your ISAs, your savings, those accounts that you can go in and dip into easily, these cover your short term. So you can see, guys, we've got a mixture of short, medium and long term types of assets here. And really the outlook is very, very uncertain. That's why we've got a lot of volatility, and so there's a lot of volatility. So guys, the smart things you can do is ask yourself some great questions. If you don't like where you are, you need to change it. So to give you, I've got a few different pensions from employers, and just to give you an example, I was heavily invested in equities, quite diversified. I manage everything myself. I put my money where I want it, but I am now holding far safer, or far less risk, far more risk averse positions in cash and a very small number of bonds. I've got a very small amount of equities because I still feel like I'm more than young enough that I can actually absorb some of the volatility, and I do want a little bit of exposure, but I've actually reconfigured everything around my pension. My savings are hugely diversified, and my ISAs are pretty diversified as well. Albeit I've got a stocks and share ISA, and I liquidated several positions, and I'm now just holding cash. And guys, I'm not saying that that's the right move, but I just want you to know and give you an example of the kind of moves that we are making and how we're thinking about this risk. Because guys, you've got to think about what is really valuable to you. Some people will want to chase a lot of upside, and they'll always want to be where the profit is. And that's fine. I'm not judging them at all. I'm just giving you an indication of what they do. For me, I would rather get rich slowly. And I would rather sleep very well at night. And so the strategy that we kind of have is one that it's allowed us to build up wealth at a very nice pace, at a very nice stage of life. And it's one where I feel very confident about the outlook, because quite simply, we are assessing our risks. We're looking at the world, we're looking at the events. We look very closely at our risks. We understand key fundamental questions that drive real performance in our investments, and if we don't like it, we get out. That's what we do. You know, we're looking at taking on another property. I still can't decide if it's something that we should be doing now or if it's something that we should do in 6 months' time. I can't decide, and we're discussing it, and we're trying to think about really where we stand. Now, we could afford to do it now and take on all these different risks that I've identified. I just don't know if it's the right call for us. We got to think about it. In the markets, though, there was no way I wanted that exposure, and so we got out. And honestly, guys, I've been sleeping well because I don't have the same risk that I had before. I don't have the risk of losing as much money I had before. What we haven't covered as much on here is commodities. And guys, you know, just to summarize my position on that, you've got things like gold, silver, and you've got other stores of value, including Bitcoin, which are looked at as being excellent hedge instruments. Because they are instruments that have typically, certainly for gold and silver, their performance over time has been far more stable, and typically they offer you a kind of insurance for the performance that you see in the market. So basically, if assets become more expensive in the stock markets, they become more expensive on one side, you might find the commodity prices are slightly depressed. Whereas if you get some overpricing and then you start seeing asset prices fall on the stock market side, you then often find that gold, silver look a bit more expensive, and the same with Bitcoin at the minute as well. So the fourth area then, when we'll just drop it on the board, we'll make it complete. Number 4 is gold, silver, and Bitcoin. And all I'd be saying here, guys, is these are great assets to help you diversify. They're stores of value that help you have a different type of risk. I'm a believer in having some exposure. I don't know. Look, what feels reasonable? 5%, 10% of your portfolio. It really depends where you're at, and it depends what your risk appetite is. I know some people who are very heavily committed. Fair enough, and they can do that. But guys, these are the kind of big decisions that I want you to kind of really be thinking about now, because our finances, our money is being stretched more than ever before. And these kind of core questions and this kind of level of analysis is what's going to help protect you during these tough times. As ever, guys, please smash the like button if you've enjoyed the content. If you've got any comments, questions, queries, drop them below, or email us avoidingbroke@gmail.com, and we'll be happy to get back to you. We're loving the engagement we're getting. We're loving the vibe that everyone is providing. And guys, I think we're doing some really important work as a community to help navigate these uncertain times. So please keep contributing. Please keep liking and sharing. If you're new to the channel, please keep subscribing. And guys, we together are going to get through this really tough time. Until then, have an awesome weekend, guys. I'm looking forward to seeing you. Should be tomorrow for the podcast. Until then, guys, take care. Bye-bye.